Well, let's kick off with what is happening in the markets right now. We began the downtrend yesterday, and the non-farm payroll figure just pushed us further into negative territory. Wayne, your view on general equities at the moment?
Look, Bronwyn, I mean, you can say that this downturn in the market started about the second, third week of January. So this is just a continuation of it. There's two reasons why this has happened. To me, the biggest single reason, I mean, the Dow Jones was up almost 60%, virtually without a pause, since March last year. So the market was looking for a reason to fall. The second reason is the reason why it's falling, is that people are worried about sovereign debt, the pig nations. Now, are they going to default? The answer is no, they will not default. I mean, the European Union will come to their bailout. There'll be very, very stringent criteria placed on them, on their budget deficits, etc. But they're not going to default. So the market was looking for a reason to fall. It's falling now. And as long as you believe that global economic growth is still on track this year, that Chinese growth is still on track this year, you should be buying shares into this weakness. But it's difficult because the major correction we saw last year is still so close, and we're so emotional about this that when we start seeing the market falling 5–10%, we think we're going to see a recurrence. It's not going to happen. I mean, you should actually be buying shares into this weakness, but as I said, it's very difficult psychologically to do this.
Johan, commodities under pressure. We've got platinum down $31, continuing what we saw yesterday. What do you make of the news flow and the impact that it's having on commodities? Obviously, the stronger US dollar weighing considerably on that commodity basket.
Absolutely. I fully agree with what Wayne said. It's driven by short-term news that came out. The news out of the US and the Europe has been bearish, and it's been driven commodities down, and the commodities market is going to, at the moment, react to news like that. That's going to, impact whether it's positive or negative. In this instance, it's been rather negative across the complex.
Further sell-off, are you expecting as we move into next week?
It's going to be a function of what the economic indicators are. Fundamentally, we don't really see reasons for this sell-off. So it depends what news is coming out. The news that just came out of the US seems to be slightly mixed, and we see a slight correction in the markets.
But fundamentally, you believe that we're still on a firm footing. Is that what you say?
Absolutely. We still believe oil and base metals. Our view has not changed. We're still positive. We believe that specifically the OECD demand is going to come through for base metals. For oil, we just think we're sitting at close to the floor level that the market will entertain. So from that point of view, we're bullish going forward.
A buying opportunity, you say, across the board, Wayne?
Yeah, look, I mean, there are still some sectors. We're quite happy that platinum shares are falling massively because we don't own any, because we thought the shares were very, very expensive. So should they fall some more, we'll go and buy a little. But certainly, generally speaking, there is value in the market now on let's say, a one-year view. We should be buying now, but we'll still maybe sit back a little bit on the consumer industrials and the platinum shares. But the diversified miners, the banks, general industrials, we are buying.
Well, let's break down the commodities and start with what we're seeing on the gold price at $1,060 an ounce level. Are we going to see support, in your view, at $1,000 an ounce?
Oh, at 1,000, yes. I'm not sure where the technical levels are, but most certainly I don't think the view there has changed. But gold, unfortunately, very much driven by the way
emotion. Yeah,
by emotion and by the dollar. And at the moment, well, most certainly from yesterday till today, it has been negative, and we've seen the price come off rather dramatically. We think on the long term, all the drivers are still in place.
Well, I know you're not a currency strategist, but there are people out there on a purchasing power parity basis who look at the US dollar and say it's undervalued to the euro at the moment. We should be looking at fair value at around about 130. If we do see the dollar, it's what, 138 at the moment, 136.92. If we see it going all the way to 130, how significantly could that impact the commodity basket again?
Unfortunately, because commodities are priced in dollars, if the dollar strengthens, it has an impact on the commodities. So you will see a shift, downwards.
A significant shift downwards.
That depends. It depends where the fundamentals come through. I mean, if you believe in the demand that is going to come through and the recovery, etc., at some point that is going to provide undertone to commodities. So we don't see commodities falling falling, you know, through the floor, so to speak.
Barclays Capital at the Mining Indaba, their analyst on the commodities front, saying copper at $8,500 a ton, 2013.
That's very, very possible. I mean, that's quite far in the future. You know, where we are now.
Well, you're basically saying that you believe in the fundamentals.
Yes.
Look through the fundamentals, look into the longer term. So let's look longer term. And if that is a view, I mean, potentially then look through the volatility and say where are commodities headed over the next 3 years.
Absolutely. You know, China is going to come through again. At the moment, we had last year we had the stimulus package. Now that we think has worked itself out. We've seen the restocking that has stabilized in China, but the underlying demand is most certainly there, and it's just going to grow. I mean, if you look at a GDP growth of 10% per annum, that is going to filter through to commodities, which, you know, is driven by underlying demand. So yeah, absolutely.
Johan, thank you very much for your time. That was Johan Maria from Absa Capital. Coming back to the basket of platinum stocks.
Yeah.
There are commentators out there who say that the platinum prices before the pullback that we've seen right now, we're pricing in that $1,800 an ounce level.
It probably was somewhere around there, Bronwyn. I mean, the shares were pricing in our view, a much higher price than was currently in the market. But these shares have come off dramatically. I mean, maybe, you know, as I mentioned early on, we might still steer clear of them for a little while, but they're certainly becoming more attractive now than what they were a week or two ago.
So you've got a second bite of the cherry if you missed it the first time around.
Possibly, yeah. We literally virtually don't own any platinum shares because of what our view on the valuation. So come back a little bit more, you know, if we're lucky, maybe the platinum shares come back another 5 or 8%. At that point, we might be buyers. But right now, we're not buying the platinum shares, we're buying other parts of the market.
The non-farm payroll number today
Yes.
was key for the market.
Yes.
And obviously it surprised on the downside.
And the upside.
They were, well, the 9.7%, yes, absolutely. But still, the non-farm payroll number, they were expecting a positive print and it was nowhere close to that.
Look, I mean, it was minus 20,000. The market was expecting plus 5,000. So that's 25,000. Now, in the worst of the recession, you know, we were shedding 200,000 jobs a month. You know, so things are significantly better. I don't think it's missed the mark by much. I don't think 25,000 jobs, when you've already lost 8 million jobs in an economy the size of the US, I don't think that differential is huge. It doesn't mean the market won't fall.
Market's overreacting then.
Yeah, markets, it's got the bit between its teeth on the downside, same as it had the bit between its teeth on the upside in December. The 9.7% down from 10%, the overall unemployment rate is far more positive news, I think, than missing the target. But these are volatile numbers. They're month-on-month numbers. They're always revised. You've got to sit back and look at the fundamentals. Is there any chance US interest rates will go up this year? There is no chance. Is there any chance inflation will go through the roof this year? There is no chance. Is China going to kill their economy by upping their bank reserve rates or margins? There is no chance they're going to do that.